Morning, Jeff.
Morning.
How are you?
Good. Live here in Indianapolis.
So we're on a streak now. We did Omaha for multiple of these, and now for several we've been on the road. So we are in Indianapolis at Oak Street, joined by Alicia Chandler. Let's show her slide. We'll be right back. All right. Morning, Alicia. How are you?
Good morning. I'm great. Thank you for having me on the podcast.
An absolute pleasure. I'm so glad that you agreed to do this, and really excited to get into what I think will be a little bit different than a few of the other topics. So just to set the stage before you introduce yourself and Oak Street, we created this as a way to sort of educate the general listener all things M&A. So we've covered the investment banking process from a seller's perspective. We have talked to a seller that has joined Carson and took over a family practice. We've talked with Fidelity. We've talked with a matchmaker in the space. But what we know from looking at a lot of the detail is that a lot of the transaction is happening not at the aggregator integrator level, but from the individual team or practice that's buying another individual team and practice. And one of the common questions we get is, how on earth do we fund something like this?
Where do I go?
Exactly. How do I start? So before we get into our questions, because we got a lot for you today, would you just take a moment, explain who you are, how you got to the space, what Oak Street does, how it's different from a traditional lender?
Sure. So thank you again for having me. So Oak Street, we've been in business since 2003.
Okay.
And so Oak Street started on a piece of paper with Mr. Denon, our CEO, when he saw the need for cash flow lending and the difference with the intangible asset class when you have the cash flow based businesses.
Right.
And so thinking through that, we started out with insurance. And then I'm going to say about 9 years ago, when we were purchased by First Financial Bank out of Cincinnati, we started in the RIA space or the advisor space. It's a very similar recurring cash flow model. And so since then, we've been doing the RIA space as well. What we have here at Oak Street is we have a full team of dedicated lenders and underwriters and processors and a back-end servicing team. And all they do is focus on the RIA space. So, when you talk about how that's different from a traditional brick and mortar bank, we don't have to be educated by you, the borrower. We come to the space with the knowledge and the expertise of what your clients look like, what your assets are, how you conduct your business. And so we're having those educated conversations with you about how you want to grow your business, what your acquisition might look like. And I think that's a huge difference from your traditional lender or credit union.
I think that's a key, like you said, differentiator. And it's something that anybody who's trying to explore M&A in the financial service industry should understand and know that if they are looking for financing, there's very specific firms like Oak Street Funding that can cater to them and already understand the industry to help them and guide them in that financing structure.
Yeah, we took a couple of minutes before when we were just sort of talking through questions that we wanted to make sure we got to today. And one of them, you were talking about an example of where more often than not, you're educating both sellers and buyers, just how some of these transactions look and work. And we had mentioned we do the same sometimes with attorneys when folks don't have a Ted Motherall or a Potomac Law or somebody that specializes in that space that does RIA M&A. So let's get into why it's different. So I think a lot of advisors assume, okay, I found a book of business for sale, or I found an opportunity. This is a great cultural fit. How do I get started? Because I think a lot of people think, well, I've got a relationship with the local bank. I can just walk in and start a loan process. What are they going to counter if they do that versus coming to a firm like Oak Street? And how is that prep process a little bit different?
So that's a great question. So I think one of the big things is, you're going to start talking day one to a loan officer or an RM that actually understands your lingo. So when they're asking you for initial documents to review to start looking at your deal, they're going to specifically ask for the documents that you have in your business. They're not going to say, well, what do you use to look at your financials? How do you do this? How do you do that? What can you show me?
Right.
Well, our people are going to actually be asking the specific list of the documents that we know that you use to operate your business and that you have with your custodians.
Mhm.
We're going to take a look at those agreements. We're going to take a look at your financials and be able to understand all of those items listed on your financial statement. Whereas if you have a lender that's only done real estate or C&I, they're not going to really understand, I think, those items that are set out on your financial statement that are of an intangible nature.
Right.
And they're not going to be able to get their probably credit person on the other end to understand, well, where's the collateral?
Yeah.
I don't
That's right.
see anything I can
Yeah.
grab or touch. I don't have
Right.
real estate. So I think that's one of the biggest differences. And they're going to be, my team is very consultative in that regard. And they're going to ask very, I think, questions that because of all the deals we've seen, they're going to ask really those types of questions that are going to generate even the buyer/borrower to think, what else might I need for this transaction? What haven't I thought about? Instead of just bringing a deal and, signing a bunch of paperwork. So it's very consultative.
So I think when someone who's exploring financing, they might not necessarily know Oak Street is an option for them. So I think what would be interesting for you to share is, how big is Oak Street Funding? What have you guys grown to year to date and over the time since you guys been in existence?
Sure. So, we've, as I mentioned a little bit ago, we've been in existence for about 21 years. And during that time, I've seen our staff grow from probably about 25 to 79, where we are today. And our assets that we have on our loan portfolio today have grown from about 300 million when private equity sold us to about $1 billion today.
That's incredible.
So, and I've been here for about 13 and a half years
Right.
in my role as general counsel prior and now president. And so it's been really exciting to see this explosive growth under the leadership of Mr. Denon and with a lot of the same leadership team that I started with 13 and a half years ago.
Yeah, that continuity is a lot of fun too.
Yeah.
When you get to grow up at a firm and see those folks kind of continue to take more and more responsibility and see the firm turn into something special.
Yeah. And with this RIA space, it has become our largest vertical in the last 2 years. It's really exploded in terms of the various lines of business that we do, insurance, RIA, and CPA. So it's very neat to see the growth of this industry, the variety of deals, the creativity of the advisors in the buying and selling of these businesses.
Sure.
It's never ending.
No, I had a mentor in the space that always used the quote, if you've met one independent financial advisor, you've met one independent financial advisor. And I think there's a lot of truth to that. There are so many ways to do business, so many ways to get creative around a deal, so many different ways why a deal makes sense or somebody would even want to pursue something. So let's spend a minute talking about that. Because I think for a lot of advisors, the question comes up, well, what's this look like? I mean, what do terms or structure typically look like for an advisor that approaches Oak Street for funding to buy out another practice or business?
And you mentioned creativity. So maybe you kind of walk through an example or something that you've worked on previously that you've helped an advisor structure that.
Sure. So I can touch base first on just what a typical deal might look like. Again, they're
knowing that there's many flavors.
Right.
Yeah.
So, our typical deal term is going to be up to 10 years fully amortizing,
Okay.
Which I think is a very good structure for people, right? They can anticipate that amortization over the 10-year period. We will do both variable and fixed rate loans here at Oak Street. And when you're looking at that, the base rate for our loans is the treasury rate. And so if we're doing a variable rate, we're going to be looking at the 1 month treasury, which today is a little below 5 as we sit here. And we're going to add a spread on top of that. And that spread for us it's risk-based pricing. And so we're going to take a look at the cash flow and the leverage for each specific deal. And depending on that and a few other factors, we're going to add a spread on top of that. So that spread could be anywhere from 3.5 up to 5.5, depending on, obviously, again, the strength of the deal. And, again, we can also look at fixed. We can look at a 2-year fixed product, a 5-year fixed product, which will be based on those treasury rates. And after that fixed period, the loan would go to variable.
Okay.
So we have a couple different options. And I think that right now people are sticking with the variable rate with all of the changes
Betting that
going
it's going to
on.
go down.
Or
Sure.
it shows a
market.
level of flexibility too. Right?
Correct.
Provide.
Right.
And how about success rate? So if an advisor has done multiple transactions and pulled through those assets and the revenue, does that success rate factor into the risk score? Or on the inverse side of that, if an advisor has never done a transaction, does that impact the amount of risk involved in the deal?
It sure does. When we get someone that's a first-time buyer,
Right.
that's when our sales team and our underwriting team really needs to have that, those deep conversations around the reason for the purchase. As I know you guys have seen this a lot lately, is really the why. And, what are the synergies between the firms? What is the reason that the seller is looking to sell? What kind of team do you have in place? What is the investment philosophy? And so that's when we're really going to be digging into those intangible type of questions. And if it's someone that's done a couple transactions, we're going to look at the historical retention of those purchases. We're going to see if there were any hiccups. And, if they've had a hiccup with a deal, really what we want to see is, what have you learned from that?
Sure.
Have you changed your due diligence process?
Yeah.
What specific item caused you to stand back and say, you know what, that's a great learning experience for us going forward? So it's not necessarily always a bad thing, but it's something that we'll take a look at as well.
Yeah, I would imagine there's a lot of education you're doing too, around items to watch out for or to look out for. And I would imagine there are times when maybe it's a repeat buyer that you've done work with in the past, you've loaned to in the past, where you might look at a deal at the due diligence and you're having a really candid conversation around, hey, we can do this, but it might be in your best interest not to, or think a little bit different about this deal than maybe you have in the past. So I would imagine that consultative relationship you're building with some of your repeat buyers is really important to them and part of the value that a firm like Oak Street provides.
Yeah, I think it is, because the things that, we'll take a look at is, the variety in the book of business. And if we have some concern about, maybe the average age of the book,
right?
Obviously, that's something that I think everyone would be concerned about, and the average household size. If there's any concentration risk, that's a huge one. If there's a large concentration of a specific, maybe a family or an individual in the book of business, there might be a different structure that we're comfortable lending, or a different maybe advance rate that we're willing to lend up to, and that the seller might have to take a longer earn out to ensure that, those assets transfer over and that everyone is aligned. And I think at the end of the day, for us, when we're looking at these deals, whether it's repeat borrowers or first time, we're really looking for the alignment of the buyer and seller.
Amen. Yeah.
That's huge. Well, and it sounds like there's a lot of things that you guys are looking at that a buyer's also looking at when they're applying evaluation of multiple on the business.
That's right.
So I mean that's great to hear and great to see.
Yeah. I mean, if you had mentioned about creativity, and I think it also goes back to something you had mentioned, when we're dealing with, sometimes we have these first time buyers and sellers, we will spend a lot of time, and this could be from my in-house counsel in the salespeople, to having even consultative conversations with the seller and the seller's counsel on who Oak Street is, why we're here, the fact that we've been in this business for a very long time. We've seen many types of deals. And so we're taking that, almost an educational approach of, this is the types of deals that we've seen. These are the common structures, and really get that seller comfortable that even if you do have a subordinated seller note or an earnout, you're going to get your regular principal and interest payments.
Right.
And look, when you're selling your business, you're wanting to sell it to a person that's going to continue on with your dream, to take care of your staff, to take care of your clients. And as long as that's the case, there should be no concerns with, with that seller note or earnout.
Yeah. I would imagine, just like we find ourselves, you end up being almost a therapist to these both buyers and sellers. And we were talking last night at dinner, and I know I'm a broken record on this, but it's not as easy when you decide to sell something that you have invested your entire life into. It oftentimes carries your family name on the door. It is the largest individual asset that he or she is selling, that is not as easy as deciding to use a different dry cleaner or a different grocery store. I mean, that is a major life-changing decision, and it carries a lot of weight with it. So having somebody that you can trust to walk you through the process, whether that be the buyer, whether that be a lender, whether that be a banker or an attorney, that is so critical to the success, because there's going to be the oh shoot moments as you lead up to completing the deal that you want to be able to bounce those ideas off of and have somebody that's going to have your back.
Well, and I think you bring up a good point, because every step of the way, people are talking you through the process. Like you mentioned, whether it's your financing or the M&A attorney. I mean, we spoke with Ted, and he said oftentimes Ted Motherall from Potomac Law. He talks to his potential sellers and helps them walk through the process. So it sounds like similarly, you've had multiple occasions where you guys have had to do that throughout the process as well. So I think it's really important to have someone who's specific to your industry, understanding your industry, understanding your business, to be able to walk through it. And Oak Street Funding would be a great example of that.
Yeah,
That's actually the other comment that I'll make is, for example, Susie McEwen,
Yeah.
who you know,
who is just a lovely person, can I
Yes,
say? Like,
she's-
we love seeing her face at every conference we go to. She's
Well known in
wonderful.
the
She's
industry.
If you're having a bad day, talk to Susie.
She's a wonderful representative of the firm.
But she's great about talking with these sellers. You know, as you mentioned, you have some of these sellers with what you call the founder syndrome.
Yeah.
And it's very emotional, and rightfully so. This is their entire life's work. And the buyers/borrowers that we have will say, Susie, can you please call whomever and help them understand, that this is not just a one and done. This is not something that this is your first time doing
Right.
it. And, thinking back to the traditional bank, a traditional banker is not going to be able to
The
have
loan
that.
officer's not calling.
Right. They're not
walking
going to
you
call
through
a
it.
seller
Yeah.
and say,
Mm-mm.
look, this is my name. This is how long
Yep.
we've been doing this. This is the type of things we've seen. And to really, I think, get them comfortable that, we're here for everyone's benefit. And we're not, as a lender, we're not going to take on a risk that we're not comfortable with. That's just not what lenders do.
Right.
And so, if we don't think it's a good deal, we're not going to finance it.
Sure.
And so, it's just a lot of that hand holding
Yeah.
that I think is very important. And we have people that will say, if you're not comfortable, you can call so-and-so that has done a loan with us. They will speak our praises. And we do that quite often as well.
I think that's great. Your clients are not just a number. It's the
Right.
relationship aspect that really matters when you're helping somebody sell their life's work.
Yeah.
Mhm.
So let's talk about interest rates. You brought up fixed and variable, and it has been obviously even a hotter topic for you over the past several years, since it directly impacts your business. But how about in terms of volume? How have shifting rates impacted total volume over the last, let's just call it 2.5 years? And more recently, has there been greater optimism around getting a deal done with the recent decrease? Has there been an uptick in inquiries or questions around what this might look like?
Sure. So, I think in the beginning, when the rates had increased, it was a shock to a lot of people. And I'll say especially first-time buyers and sellers.
Alice, we talked about on the
yeah.
way over here. I
Right.
imagine. Yeah.
I mean, you have, I think, some of the larger players that were seeing it as a cost of doing business. But if you've never borrowed before and you're looking at, a difference of 5%, that's huge. But as time's gone on and people continue to see that there is that need in the market to, continue on with buying businesses and consolidating and keeping up with your competitors, it is a necessary cost of doing business. And so, we did see the resurgence of the deals, I'm going to say in early 2023 into 24. And, when the news started coming of rates looking like they're going to start dropping, in the last couple of weeks when we've been at conferences that you guys have been at, the M&A and succession conversations have ticked up. It's been a huge swell of activity.
Yeah.
And I was talking to two of my loan officers yesterday, and they are drowning in applications. So I know that activity has definitely followed.
Yeah. What a great
market.
problem to have.
So
Yeah, I think you're absolutely right. And volatility in the market certainly plays into that too. When you have EBITDA numbers or bottom line cash flow maybe being lower than you expected, combined with the end of what had essentially been free money for so long, If you were a first-time buyer, I could imagine, or on the flip side of that, if you're a seller and you're seeing cash flow down, knowing that that's what you're going to ultimately be judged on, it can't help but have some level of impact. But I think that jives with what we've heard, what we've seen, especially over the past year in particular. There's been a just absolute resurgence in activity, or folks approaching market, maybe that even shouldn't be, for that matter, deciding to get into this space.
Yeah. And I think like in our space, a lot of times it's viewed as like, hey, I'm buying cash flow of a business. But I think M&A has turned into a shift of, it's a talent acquisition play now.
Almost every time.
And so it's like, not only are you buying that cash flow, but in order for you to take your firm to that next level through inorganic growth, you're adding talent that's going to help you get there organically or inorganically as well.
Yeah, or supplement an offering that you're not offering to the client base today.
Yes.
Yeah, that's great.
Yeah, we've seen a really big uptick in people that are, looking when they're acquiring a firm that maybe only has, 2 or 3 people. They're really taking a look at not only that maybe 100% seller, but they're looking at those junior advisors to see, are those people that we can bring into our team and fold in and help in long term, right? To be that succession to the existing advisors that they have on their own team as well.
Yeah, I was, you and I were both at the DeVoe conference, which I'll just shamelessly plug. That's one of my favorite conferences all year long. They do such a nice job. But when I was speaking on a panel on that Friday, I had asked the question, who here is looking for really talented junior advisors to G2s? Almost every hand in the room goes up. I mean, that is a major problem we have in the industry. We are not backfilling the amount of advisors that are exiting with really talented young folks. So you're right, Jeff. I mean, a lot of times it's not just a play for the assets, the clients, or the rainmaker, the founder. It's that bench strength behind them. And when you see that second generation of really talented folks that maybe you're not ready to take on a a couple $100 million book of business today, but maybe they could in 2 or 3 years. There is a premium that you're going to place on that business when you do valuation.
Yeah. And let's stay on this topic of the junior advisor, because I think it's really important, because we come across a lot of firms where there's just one advisor who owns the entire business. How have you worked with advisors to structure the G2 to finance and purchase that G1 out? Maybe talk about an example that you've worked with.
And if I can add on that,
Yeah.
how has that changed with the valuation spike that we've seen over the past 4 or 5 years?
So actually, we had this conversation with a client that did just that, Future Proof, the other week. So, when you have that 100% owner and you have these younger folks that come in, I think it's very incumbent upon both sides to have those honest conversations years in advance of any idea of a transition actually starting, to see if they're the right fit. Do these, and in this case, it was 2 younger women, were they ready to step up into management? Were they really to step up and be those, I'll say, new face with the clients and to work in the financial aspects of the company? And so they put themselves out there to this G1 very early on and said, we do want to be the next generation. And so they stepped into those, I'll say, COO, CFO type roles, probably 4 or 5 years before they then went ahead with the actual succession plan that got them into ownership. And so during that 4 to 5 year plan, what they did was they talked to our lending team. They talked to Susie. They had those conversations over a 4 to 5 year period about where they were looking to go, what that succession plan might look like, talking to the G1, figuring out what the actual documentation should look like, how long G1 wanted to even stay on. And so again, it was a very well planned out, very well thought through process, which included the lender on the front end, us. So it, when it came time to execute upon that plan, what we needed to collect from them, they had it. They were able to hand that over to us. And that's very unusual, but that's really how, I think it should be. And you guys have seen that.
Totally agree. Jeff and I were at a launch event for our Fisher team in Hanover, New Hampshire 2 weeks ago. And Matt from our West Des Moines team was telling a story around this. And they have a very finite process around the handoff from G1 to G2. And it goes 4 years, and it involves things as simple as certain phone calls will be made by the G2 to communicate one particular item. And the whole design of that is to inculcate trust over multiple touch points so that eventually that client knows that the G2 is the G1 for them.
Yes.
And that's the relationship manager.
Yeah. It's not just necessarily the client conversation, because I think that's huge, because as a G1 stepping out, you need to have that transition of the clients down to the G2. But doing it early could potentially allow you to purchase the business in tranches rather than all up front.
At a more manageable valuation.
Right.
Yeah.
And you know, you had mentioned valuations, and I think, you know, what we see, especially now with our pipeline full of buy-ins and succession type of loans, is, you know, you have a valuation and it's typically going to be external facing.
Right.
You know, when you have these internal transitions, there's going to be what you would call a discount to the valuation. But everyone's comfortable with that, because I think, you know, at the end of the day, it's all about that G1, whether it's one person or a couple people, wanting to see their baby transition to people that they trust to carry on their legacy, their family name, their clients, and their staff that they've been so dedicated to for so long.
Yeah, I totally agree. And there are so many times when we have that first management call with a prospective seller and they're looking at Carson, where that is the rationale. That's the investment thesis. It's not the payday. It's not, oftentimes it's not even necessarily to say, hey, we want to offer tax services or estate planning to our clients. It's, I want to make sure that these junior advisors are taken care of and that they've got a home where they can thrive, because if they're thriving, we know that those clients are going to be well taken care of. And there's that continuity of care. So I think that's so important.
Yeah. Well, and I think just from a buyer's perspective, Carson's perspective, we like investing in a firm that has multiple owners. So if there is an owner who's listening today that has 100% and is going through the thought process of, hey, I want to get equity in my G2's hands, they need help with financing. One, talk to Oaktree Funding about that. But two, do it earlier rather than later, because it's going to make your business a lot more valuable in the eyes of a buyer.
Yeah. Amen.
And you mentioned tranches, and there are so many ways to do a deal, but we have seen and we are able to do tranches. So if a buyer and seller, G1, G2, want to do, you know, 5% year one, 5% year two, and so on, we can fund those tranches on an annual basis until it gets to a point where perhaps they want to do a total buyout.
Right.
You know, the other way, and perhaps you guys have seen, is if there's, say, 5 junior advisors that want to totally buy out the founder. You know, we've seen that as well, where it's kind of an all-in-one. You know, so it's, again, every situation's unique, but we can handle it all, and we're happy to you know, take a look at those different situations.
Well, it makes those conversations so fun. So when we were chatting beforehand, and this still boggles my mind, is we've got 3 relatively experienced travelers here, but let's talk about expired driver's license. You had mentioned having the right documentation from the get-go and being able to educate folks on what that is when they approach Oak Street and say, okay, I've got something that I think I want to pursue. So would you take a couple moments just to describe what should people be doing to get their financial and documentation ducks in a row prior to coming to see you?
Right. So that's a fabulous question. And I know we've been down this road. You know, I think obviously what you need to have in hand is you need to have your last 3 years tax returns, your last 3 years financials. If you've worked with a CPA and they're reviewed or audited, all the more, you know, that's better. But if it's not, that's fine too. But, you know, you need to have the accessibility to those items, and you need to have familiarity with those items as well, with the financial aspect. Be able to explain if you've had a dip in revenue year over year, what happened, you know, and just be able to explain those items. And, you know, in terms of the legal, it's going to be things like making sure you have your articles of organization or incorporation, your operating agreement, your bylaws, whichever the case may be, copies of your stock certificates, a list of owners, unexpired driver's license. And again, these sound very simple, but we see it quite often. Yeah. And so, you know, I think I harp on get your financial and your legal house in order. Right. And a lot of times the easy way you can do that is to work with an industry consultant or someone that understands the business and can really, you know, help you understand, like, here's what the lending package is going to look like. Or getting in touch with one of my lenders and saying, what do I need? Even if you're not ready to do a deal tomorrow, you need to understand what a
Mhm.
lender is going to ask for
Yeah.
and be able to gather that information to be able to provide it, when the time comes.
Right. I would imagine you guys have a checklist of some
We
sort. You,
do.
you provide
Yeah.
a loan checklist for
Mhm.
everybody.
And
That's great.
And we can, depending on the deal, if it's M&A, if it's succession, the partner buy-ins, that checklist changes.
Yeah,
So
that's
there's
right.
not one size fits all either.
Yeah, ours does too. I mean, I'd
Mhm.
say whether somebody has their
Oh,
own
we- ever
independent
evolving,
RIA,
Mhm.
part of a corporate RIA, it
Mhm.
changes what we're going to look for. Obviously we're not going to ask somebody for a compliance manual if they're part of a broker dealer. So that's interesting.
And
So go ahead.
just real quick, the
Yeah.
other thing that I know you'll appreciate as well is we're going to take a look at that book of business, right? The
Yes.
assets under management.
Yeah.
We're going to dig through that. We're going to look for any concentration risk, the average age of the client, the household size. So we're really going to get into those type of details as well, and just really understand, what the book looks like. If there's been any organic growth over the last few years, what that looks like, and really take a hard look at that.
That is such a major topic for us right
Yeah.
now. The organic growth
Oh,
component.
yeah,
I mean, that is the
absolutely.
single most important driver of valuation. I was at a conference in New York earlier this week with Pershing BNY, and Bob Worrells from Hightower was on stage talking about exactly that, just how important it is to see some level of base organic growth exclusive of market so that it shows a business development mindset.
Mhm.
He talks about how if somebody's at 0 to 1, I'm not going to take you to 15. But if there's 5 to 6, I know I can do some things to juice that or make that more attractive.
Mhm.
And our CEO, Bert White, has talked oftentimes about the sort of leaky bucket problem that we have right now in our industry. Most
Yeah.
clients are working with advisors that are inside 5 years of their own age. So as we see this succession crisis with advisors, that is coinciding with, God forbid, clients wanting to actually withdraw the money that they've spent their entire life saving. So you need to be growing at anywhere from 5 to 10% just to sort of tread water with client distributions. If you're of, a more seasoned age in our industry and you're looking
And it
at
goes back to just having a deeper bench on your own team with different age and demographic groups so that you can help fill those holes in the bucket.
Yeah.
Right. So
Yeah.
Right. How many times do we see that, you get that G2 in there and the organic growth explodes?
Yeah,
It's amazing.
it's
Like they've been holding back, just,
Right.
waiting for that opportunity. And that's really neat. I love hearing those stories of, these G2, the women that I was talking about, they bought in, and the amount of organic growth they've had year over year is just phenomenal.
Right.
And they're very proud of it. And the sellers are proud, right?
Oh,
The
they should
G1
be.
is just so proud that this is what they've left in these folks' hands, and they've done so well with it.
I mean, they're
So,
driving such tangible enterprise value for that G1 advisor. It's really exciting to see. And the enthusiasm there too. It's just, it's catching.
Yeah.
Okay. So as we wrap up, how about any lessons or something that maybe you would impart on a younger advisor that is considering buying into a business, whether that's equity in a G1 or buying their own, just anything that you would offer as sort of a last shout out to that advisor listening?
Sure. So, interestingly, we had plenty of these conversations the other week when we were at some other events. I think it is incumbent upon these younger folks to ask. Do not be shy. That G1 is, they are looking for someone, and maybe there's not always that, that verbal, hey, I need someone, but it's really, I think, incumbent on you to go ahead and have those honest conversations. And if you're talking to someone and they are not aligned with, I think, what you are looking for your future growth, or don't think it is something that you want to undertake, then perhaps that's a different direction you need to take, right? And so at the end of the day, it's all about having those open and honest conversations early and getting those plans put in place so that when it comes time to buy in or to make that succession plan, everyone's on the same page and you're not scrambling last minute, or no one's having those kind of fears or anxieties pop up.
I think it's great advice. I mean, I think it comes down to listen to what the G2 is telling you.
Yeah.
If they're telling you that they want to be an owner, they're not going to be happy being a non-owner contributor. Likewise, if they say, I don't want to be an owner, you're not going to make them into an entrepreneur or an owner. They're never going to be comfortable with that.
I was just going to say that too. Like, sometimes the conversation hasn't even been had.
Right.
So how is the G1 going to even know that you are capable or willing to step up in that ownership capacity.
And I know you've seen it happen too, where they do have that conversation and maybe there's 3 folks and one of them says, it's not for me.
Right.
And that's
Mhm.
okay.
Absolutely.
But you just need
Yeah.
to understand that so you can plan accordingly with
Right.
the other folks or maybe needing to bring someone in.
And I think we can all say almost unanimously, once a deal is completed, if the advisor is of retirement age, after the deal is completed, they say, I've been getting this question from my clients. My clients have been asking, what happens to my accounts or my relationship if something happens to you or if you decide to retire? So that the questions being asked, it's time to start thinking thoughtfully about it now and getting the G2 involved.
Yeah.
Right.
Awesome. Well, Alicia, thank you so much.
Yeah,
you have
thank
a
you.
wonderful studio, wonderful staff. Thanks to Kira for setting this up and Susie for hosting us. Chelsea, I know you're out there. Thanks for producing this. We appreciate everything you do.
All right. Thank you.
Thank you.